Thank you everybody for attending. Again, Zoom platform, please put your Q&A into the Q&A section so that we can have a fruitful discussion as the second half of the presentation. In terms of a simple run through, I will be reviewing a prepared overview of the research report that was published last month by EverEdge and the Eibi benchmark index. And then we will have a panel discussion with our invited speakers and our confirmed panelists. So I will do a quick introduction of the videos that you'll see or the photos of people that you'll see. We have Kitt-Wai, who is the managing director of IPOS International. Thank you, Kitt-Wai, for joining us today. We have Sivi Sivanesan, who is the head of corporate practice at Dentons, and thank you. And Yu Ong, who is the director of equity capital markets and global sales and origination for SGX, or Singapore Exchange. So thank you everybody for attending. And Richard Tiao is also, you'll see his video there popping up. He's going to be our moderator. He is our partnership director at EverEdge. So if you have any questions around anything, you can reach out to him after the event for more research, more information, more details, and even info packs if you don't have the download or you want more information about what we're talking about today. All right, so the reason we're here, capital chases growth. The title of this actually came out as one of the outcomes from doing this research report that was put together. So I'll go ahead and kick this off. If you've never heard of EverEdge, we are an intangible asset specialist firm. We are an advisory firm, management consultants and financial specialists that focus on intangible assets. And we have offices in Singapore, Australia, New Zealand, and the US. Now, if you ask, what is an intangible asset specialist? I would break it down to people, what we do and how we help them. We break it down into a couple of buckets. We walk them through how to identify intangible assets in their companies, help them to assess the strengths and weaknesses around those, and then help them to put together strategies to best utilize the intangible assets in the business. And once you know what you have, you can actually start to put price tags on things in the business. You can put labels so you value them. Once you've valued the intangible assets that you have, you can start to monetize them or do something with them. Take them out to market, you can license them, you can sell them. And so that is effectively the simple strategy that we go through as intangible asset specialists. And what are intangible assets? Well, if you're joining this call and you haven't seen this or you haven't done a research, I'll give you a quick overview. Look, intangible assets are anything that you can't touch, okay? Simplified. Most people look at them as, if you're an accountant, you probably know them as goodwill. If you're a lawyer, you probably know it as intellectual property. Those are the types of things we're talking about today, but really it's a larger asset class. It's anything that you can't touch, things like confidential information, data, content, design, software code. And so these are things that we will drive down a little bit more today. And the reason why we focus on these is because these are really the primary drivers of company performance today. Now, to give an example of this, let's say I gave you something that you would consider a very tangible business, like a steel manufacturing plant or a steel mill. Now, you might say, well, a steel mill, it's a lot of property, plant, and equipment and not a lot of intangible assets. But a lot of the value that you see in something that is required to, safely and efficiently make steel is intangible assets. For example, you need regulatory approvals to be able to produce it to a certain quality. You need instruction manuals to be able to know how to operate and run a mill. You have to have a bill of materials to know what other elements and components you need to put this all together. You need the manpower, you need the networks and relationships to be able to, source the raw materials. So right there's a lot of assets that are intangible. And really, when those are all put together, it is that group of intangible assets that allow you to actually produce something like steel. So most of the value is actually intangible and hard to see. Now, when we talk about examples of this, or we talk about assets, we want to use case studies because they allow, help to illustrate things in terms of how intangible assets can grow and how intangible assets can scale. So up here, I've got the original 12 staff of Instagram. And at the time, Instagram was valued for $1 billion. So you take a $1 billion company when they were bought by Facebook. At the time, they had very little revenue, very little assets, only 12 staff, but they were only 20 months old. You use that as an example of a fast-growing small company. You compare that to a large logistics company like Main Freight. Okay, Main Freight is also valued at $1 billion. Okay, they have 1.8 billion in revenue, 1 billion in assets on their balance sheet, and they're almost 40 years old. So how is it possible that a conventional company, from a conventional standpoint, from a valuation standpoint, you would say these two are not equal. But yet the reason for this is because tangible assets can't scale at the same rate of intangible assets. When you look at over time, you have something like a truck. If you want to build a bigger trucking company, you have to add more trucks, you have to add more people. Every single step of growth takes more time, more capital, more physical assets, and you require tangible assets to do that. Intangible assets is a completely different story. What we're dealing with here is not the economics, but the functional laws of the universe. Tangible assets cannot be scaled beyond certain limits, but intangible assets can. Now, how is this applied into specific industries? Now, this is an important part. If you take a look at agriculture, for example, over the last 50 years, grown about 40% as an industry overall, okay? And, if you take something like, there's really no limit to the amount of grass or trees or grain or cows you can grow. And I mean, if you had enough space and if you had enough time, but because those are physical assets, you're limited. And so you have limited functionality at the speed of which something can grow, something like a plant, okay? The time that it takes to grow plants isn't going to change that much, okay? But intangible assets, when you compare an industry like semiconductors and the computers, we know, for example, Moore's law tells us that the speed of technology will double itself in a set number of years. And so it continues to grow exponentially. So if you think about intangible assets and where companies now are looking to put their money, okay, capital is always looking for growth, looking for opportunity, looking for scale. And so if you can identify your company as an intangible asset company, you'll inherently tend to attract more capital. Intangible assets can be a proxy for scalability, and scalability models outperform and can be articulated directly to investors. So if you take a look at the research that we're going to focus on, this is a graph that's been around a few years, shows the Oceantomo study that was done, and they reported, the last 50 years, the growth of intangibles has gone from about 19% from about 17% to over 90%. And this growth is what has, we know this, we've seen this, and this is one way to slice the data in terms of looking at it. And so at EverEdge, we've been dealing with intangibles for the last 12 years, and we said, let's actually dive into this and see if this research is relevant and what we can actually take out of this. Because when you just take something like the S&P, it's so broad, there's so many things that are moving in there, you need to be able to dissect it a little bit better. And so we actually produced the the EIBI, or the Intangible Benchmark Index. Now, what we did here is, the reason that we did this is because the existing approaches have focused on market cap as a measurement, and it's really looking at operating performance, and the financing choices are sort of neglected. We wanted to see a more accurate representation of where value sits across global indexes, to really neutralize the effects of financing choices. And so we deliberately express intangible assets as a portion of the company's enterprise value instead of market cap. And by doing it this way, breaking it down, taking enterprise value, lessing the net tangible assets, okay, and then you actually end up getting the implied intangible assets. What it does is it's more of a robust expression of the importance of the intangible assets for company valuations, and deliberately and really it perceptibly neutralizes the effect of the financing choices that a company has in the way that it grows. So when you do that, we said, okay, well, let's take some of the initial research, and we're not going to compare directly to it because the research timeframe that we have accurate data on that we can go into market specific industry segments, it actually only goes back to around 2005. So really, we're only looking more so at the last 20 years in our research compared to other. And what we found is, and you just focus in on that, you'll see that it dips. So you've got around the year 2000, the S&P specifically, around the Great Financial, GFC, you see a bit of a dip in terms of reporting, and then pull back, and then a slow increase from 2005 up to 2020. Okay. Now, the reason why we started with the S&P is because it's kind of the benchmark that people of markets, and it's looked to as example of a successful market. So what we did is we then looked at that against the GICS sectors in the major stock market indices. Okay, we broke it down, and overall there's 11 sectors. And when we broke that down, there was 7 sectors that had over 90% of their value in intangible assets when the companies were weighted. So that is effectively a quick snapshot of each country. I'm going to go into each one and kind of give a little bit more detail around it and the technical side of it. So please don't fall asleep. If this is too technical, don't worry, we'll bring it back. But effectively, the S&P 500, we'll start that because that's sort of the benchmark. That's the starting point, right? And the S&P 500 has the highest proportion of intangible assets relative to enterprise value. And really this reflects the willingness of the capital in the market to ascribe value to these assets. The reasons that capital has been willing to do so has been discussed, what I said earlier, is that there's higher growth rates of intangible asset companies, the anticipation of the effect actually monopolizes intangible asset, it monopolizes the things that intangible assets tend to generate. What it means is, if you're more looking at intangibles, you look at things like, the overall network economic effects, okay? And again, the United States companies have generally been net acquirers of companies in the markets compared to the other markets that we studied, due to the greater availability of capital and the lower cost of capital to US companies. So what we're saying is that because the S&P 500 has been around a little bit longer, it's actually kind of a self-fulfilling prophecy that because there's more cheap capital, they can go out and acquire more intangible asset companies and bring them in. So it starts to build on itself. So this is kind of what you would expect to see. You see higher growth rates and then superior margins of market share. I did want to call out though that when you take things, you see that we put in the laggards in there, are the ones that have declined as well, something like utilities and energy. And some of those cases, because some companies that are energy companies or heavy in fixed assets, either we've seen split offs with those companies where they split divisions of their business into different segments. So and the IP sections might get taken somewhere else, and the physical assets get managed by a third-party company, and then they have an operating business that's a service business. And so you'll end up with what used to be an energy company now is a service business, a hardware business, and a maintenance business, and then a data company as well. And all three of those end up being three separate businesses. So it's a part of the trend you're seeing. So when you see decline in utilities and energy, it's because sometimes you're seeing those break off. The next market is the ASX. Okay, Australia, we've got data here. So contrast to the US with smaller markets, as you know, we discussed in this report, there may be some preference by intangible asset rich companies to seek capital in the US. And so what happens is you get countries like Australia, New Zealand, and Singapore, where you tend to see the higher tech companies end up moving over, which is why we're seeing sort of 60 to 56. And Australia has been relatively flat because as companies have come to be larger, you see a lot of dual listings. And then at the point where they have enough support, they move over to another exchange. So that's not all companies, but you know, that's one of the reasons why there's sort of a less movement in the ASX. So let me jump now to the NZX. Again, similar. The S&P, you know, the NZX All Index has shown a consistent rise in intangibles as a value function of the enterprise value. These, you know, the intangible assets has risen to new heights on the back of COVID, specifically because of healthcare and, you know, major companies that are there, such as Fisher & Paykel Healthcare, their utility sector, and, you know, Meridian Energy. Those companies have actually pushed things up, and so you've actually seen an increase, you know, in New Zealand as we go into individual market sectors. Okay, so let's go to Singapore, right? I mean, as we operate in Singapore, we wanted to see what's really going on, and you see actually a fall in Singapore. You know, the companies have been swept up by private equity companies or listed internationally. I think it's really interesting to note that, you know, the FTSE has started in 2008. All right, and if the companies that they qualify on their index in terms of tracking, they have to meet certain criteria. And so, you know, the FTSE Russell is also reports it eliminates companies that have, you know, since delisted, so that falls out of some of the database. And there's been, since 2008, there's been about 160 companies delist, and what's sort of left, you know, sort of that makes up the majority of it. There's actually 47 you know, property heavy companies that are listed. And so what happens is you get a significant weighting of tangible assets. Now, something to comment around the Singapore exchange, right? The SGX and the exchange, it is not a proxy for the economy in Singapore. Okay, it's not saying, well, this is going down, so therefore the economy must not be doing good. They're actually not related. You may be able to say that there's more correlation in the United States because there is more of a drive, there is more of a free market, there's more free capital floating around. But there is such, there's been an increase in the amount of PE funds in Singapore. In fact, since 2017, we've seen about a 17% increase in the amount of PE funding across Singapore. And so that a lot, and in addition to that, a lot of the private equity is in is actually tied up into government controlled you know, pensions, like Temasek, for example. You know, they may control a significant amount of company pensions because it's a different structure in Singapore as it is in the United States. So the reporting ends up getting skewed. Okay, so really, even a single listing of an intangible asset rich company can significantly alter the intangible asset content of the Singapore market. All right, so just a few companies can significantly list that. And it's also interesting to note, last point on Singapore, is that, you know, the press releases that announcing acquisitions frequently explicitly mention that the acquisition has been, you know, at least in part to gain access to some innovative company, for example. Like we see a lot of announcements where they say, well, they're making acquisition of a Singapore-based company because they want to get access to the technology, which means is a lot of outside capital from the country is buying up earlier stage, and they're never even having the opportunity to list. So when you take it from the listing standpoint, you're seeing a lot of that IP get snapped up and acquired before. So really, as we take a look at that, hopefully I didn't bore too many of you as we kind of break down the technicals of the kind of outcomes of the report. Let's jump right into the actual outcomes, and let's simplify this a little bit. And then I want to get the, you know, I want Richard to run the panel, because we've got some great experts in the market that are going to give some opinions on this, and I'd love to hear their opinions as well. So look, first of all, the broadest finding of this is that intangible assets are the most valuable assets today. We see this. It's been supported by reports done by, you know, McKinsey, and we saw the Oceantomo report and EverEdge's report, and again, over 2,000 engagements that EverEdge has completed over the last 14 years supports that. We know that. That's why we're in this industry. Second, companies that harness that harness inherent scalability of these assets grow faster. So once they know the assets that they have, they know the intangible assets, they have a strategy, and they plan around that, they will grow faster. And then the last is, you know, capital chases growth, and that was the title of our webinar today, because really that's one of the main takeouts, right? If you need capital and you're looking for capital, you know, you want to be able to see growth. Now you can get growth a couple of ways. I'm going to simplify it by showing a diagram. You can identify your idea, your business, and then deploy it and go out to the market and sell your product or service and grow that way. Now that's a long path, okay? Once you get that growth, investors go, okay, I see you're growing, so now I will put capital into you. Now I'll go ahead and invest because I see there's something going on there. And that's, you know, if you're quiet, you're not outspoken as a CEO, and maybe you're technology focused and you build it and you say, once it's built, then I'll go out and ask, you know, look for more capital. The other way is if you know you have strong intangible assets and you have a story and you can articulate the value of your company over another company, you can get directly to that a capital attraction. You can get to those investors, the private equity groups and the VC groups, and even banks, okay? If you can articulate the value of those intangible assets earlier in the process. So because intangible assets can help drive the ROI that investors are looking for, you need to let them know that you're there and out there. So, I mean, that's one of the main takeaways that I came from the report. We can deep dive into the sectors individually. If you need access to the report, you can download it from the website. But really, the purpose of the webinar today was to get some more industry feedback and how this goes. And so, thankfully, we've got a good group. And Richard, I thank you for moderating the session. And I'll let you go ahead and do the introductions. And I think there is some questions. If you have questions, please put them in the Q&A section. So, and we look forward to going over them. So Richard, I'll pass it to you. Thank you.
Thank you so much, Tyler, for your great presentation. So good morning, everyone. My name is Richard Teo. So I'm the Associate Director of EverEdge, and I am the moderator for the panel discussion today. So before we start, again, you know, a kind reminder that if there's any questions from the audience, right, you're highly encouraged to post your question in the Q&A function of the Zoom. And okay, while EverEdge has developed the research, right, we'll also like to call upon our panelists today to share their real-world views and the key takeaways of the research in perhaps maybe 3 to 5 minutes per person. Okay, starting from Mr. Sivanesan. Again, once again, Mr. Sivanesan is the Senior Director and the Head of Dentons Rodyk Corporate Practice. So I'll pass the next 5 minutes to you, Sivi.
Thank you, Richard, and thank you, Tyler, for the very succinct summary of your benchmark index. It was very interesting. Yes, I agree that intangible assets are very important. They're very critical, especially in the current times. We have worked with many startups, and I would share that maybe in the last 3 years, I have seen at least 12 to 15 of the firm's startup clients who have risen past Series A, B, C, D, even E, deciding to list in the US. Right. So these are because the valuation in the US market is very much higher than that in the Singapore stock market. Right. So it's a function of the markets, not, like you said, of the economies. The Singapore economy is strong. If we probably did a benchmark index on unlisted companies, you would see a high proportion of intangible assets in the unlisted private companies. And I know that because as I work with all these startups and the VCs, we see a lot of money flowing into that. So this is private money, PE money, high net worth individuals flowing into these companies. And like you said, Tyler, 17% rise in private equity players since 2017. So that's in 4 years, 17, that's a huge amount. And private equity are the big players who come in. So obviously Singapore is doing something good to attract these investors. There are companies here and there is a very fertile ground for the startups to grow, and all of them are using intangible assets. So that's a very strong point that we have. Unfortunately, when you look at the index and the listing, yes, it may skew it another way, but I'm not too worried about that because at the end of the day, if a Singapore company lists in NASDAQ or wherever, that's fine. It's a made in Singapore product. And Grab is an example. Although I would add that Grab actually started in Malaysia, but it took off in Singapore, right? So we would like to lay claim to some fame that is a Singapore-based startup. But there are others. I know 2 of my clients currently who are looking to do possible SPACs or listings in the NASDAQ, and they are unicorn companies in Singapore. Again, strong base based on intangible assets. One thing I would like to share is, so that we all don't lose track of this, is for all the intangible assets that we need, and I hope founders and startups remember this, you actually do need tangible assets. So if you are developing or creating something on tangible assets and you think this is my way, the growth is going to be very good, please bear in mind that you do need tangible assets to support your intangible assets, right? You can create a great app, but if people's phones can't use it, if the Wi-Fi is not working, if it's not there, fine. If Grab didn't have enough drivers, logistics support cars, it doesn't work. So when you create your intangible assets, please make sure it's in line with the tangible assets that are available and that you can use for that purpose. I think that's all I need to say now, Richard. Thank you.
Thank you so much, Sivi, for your kind sharing. Next up will be Ms. Ong Yu, our Director of Equity Market Singapore Exchange. So I'll pass the next 5 minutes to you, Yu.
Hello, thank you. Thank you to everyone. Thank you to EverEdge for inviting Singapore Exchange, and also very glad to be here on this panel. I feel like I need a lot more than 3 minutes to talk about the Singapore Exchange, but I will try to stick within the allocated time, and Richard can cut me off anytime as well. Yes, I think first and foremost, what really resonated when I saw the report is the increasing importance of intangible assets. But frankly, that is not, that's a no-brainer. Because if we look at global macroeconomy today, this is where the whole world is moving towards. Technology and its ability to create disruption, ability to scale across borders, which have become more important than ever in light of the current situation, of course would be what brings the most value to companies today, whether they are private or public. Now, the point is whether that recognition of this value can be achieved in the Singapore market. And if, of course, we're candid about it and we look at a comparison across global exchanges, then it's very clear the US does remain as the deepest and most sophisticated market in the world today. In fact, the US market is bigger than all other exchanges globally combined together. I think that is in itself a testament to how deep and how liquid that market is. And that is also why you do see it as kind of a mecca, especially for tech companies. I think when we engage with entrepreneurs and founders in the region, I mean, ultimately their goal is always to go to the US because that gives them that stamp of credibility, if you think about it. But from Singapore's perspective, what we are talking about is not trying to substitute the exchange in the US. I think we are also cognizant that that's not something realistic or that makes sense. But what we do think is something that a role that we can be complementary on. You do need a certain size to be relevant in the US. So why would you consider another platform like SGX? First of all, we do have two different platforms, including Catalyst, which caters to smaller and fast growth companies, where the regulatory regime is also much more flexible. In fact, there's no quantitative criteria required. And if we look at companies that have listed even on Catalyst, there have been great successes, including technology companies who have seen ability to take off after listing. One example is Grand Venture Technology. I was just looking at this as a precision engineering company. Actually, I think IPOS would know this company very well. They have worked with them on a project to recognize their intangible assets. And it's a company that have grown tremendously in its market cap since listing. So what we want to say is that there is ability to recognize good technology companies, but we are a relatively small market in comparison to the region. So what we want to do is to make sure that we continue to stay relevant and innovative to make the platform a flexible one and one that can help companies to continue to access capital at their different stage of growth. So whether you are a small company, whether you are a mid-sized one, SME or something, or you're on the cusp of becoming a unicorn, for instance, there are always different options for you, which is also why we introduced the Specs product just a few months ago. That is something that we saw as an increasingly popular product, especially for technology companies, and one that we think could offer an alternative option that will help companies to raise funds when they need to. I think my 3 minutes are up, so I'll stop here and we can talk more at the discussion later.
Well worth it though. It's good information, and I do have some questions for you. So
I knew you would, Tyler.
Thank you so much, Leo, for your sharing. So finally, I would like to pass the next 5 minutes to Mr. Kitt-Wai, who is our Managing Director of IPOS International. Kitt-Wai?
Thanks, Richard. Richard, if you could, I prepared just two slides to share with everyone while Richard launched the presentation in the presentation mode. Okay, maybe the next slide first, Richard. So thanks again. Thanks, Tyler, for the presentation, and good morning, everyone. Congrats to EverEdge on the successful launch of the Intangible Benchmark Index, and thanks for having me. There are two slides I have prepared here and two pieces of information. They are related to IP, of course, and what we do at the IP office. So maybe one word about IPOS International. We are part of the IP office of Singapore, and together we help innovative enterprises use their intangible assets and IP to grow. Right, so the first slide on IP filings. So I'd just like to share, while during the global COVID-19 pandemic, many aspects of the economies are affected, but innovation has continued at pace. So based on WIPO, the World Intellectual Property Organization's recent report, and comparing a year ago, worldwide IP filing activities, IP is a big part of intangible, right? Worldwide IP filings have increased across over 130 national offices. So just to give some numbers, there are about 3.3 million patent filings, more than 70 million trademark filings. And nearer to our region, Asia accounted for the bulk of the increase. So if you could look at the orange bar, around 2/3 of patents, over 70% of both trademark and design increases came from Asia, right? So next slide. The first slide, rather. All right, so the other piece that I'd like to share, which is near to Singapore, is this April, this year, the Singapore IP Strategy 2030, or we call it SIPS 2030 in short, was launched by Minister Indrani and Minister Edwin Tong. So this is a national strategy that supports enterprises and the wider innovation community. So SIPS 2030 is a 10-year plan. And the aim is really to position Singapore as a global hub for intangible assets and IP activities, supported by a top-ranked IP regime. A key part of the strategy is the blue zone, if you can look at on the left-hand side, which focuses on business. And there are two key thrusts. First is to enable enterprises better leverage their IA and IP for growth. And second, to build a credible and trusted IA IP valuation ecosystem, which is really vital for the business growth. So the EverEdge report has articulated very well the increasing portion of IA or intangibles constituting enterprise value. And in this regard, we also see a need for a greater IA and IP disclosure in Singapore enterprises. So a little bit more information. I mean, we all know that the current international financial reporting rules, IA are often not fully captured on companies' balance sheets. So this is despite enterprise value being increasingly driven by IA, right, including IP. So the lack of disclosure often creates information asymmetry between the IA or asset holders and the broader stakeholders, including investors and the public, right, on the value of those assets. So as a consequence, the value of the enterprises, IP or IA, cannot be fully appreciated by the downstream stakeholders and capitalized upon for business growth. So over at the IP office or in Singapore, we recognize this challenge. So our agencies, together with economic agencies, we are all working together to enhance enterprise IA and IP disclosure and valuation in order to reduce information asymmetry in the ecosystem and downstream support IA and IP transactions. And lastly, and specifically for the Singapore IP Strategy 2030 that I've shown here, we'll be working very closely with all the industry partners to develop, for example, a IA or IP disclosure frameworks or guidelines, right, to support enterprises disclose their IA and IP. Right, so that's the short sharing that I would like to have. If you are interested to find out more about the Singapore IP Strategy 2030, feel free to download a copy from IPOS's website or get in touch with us. Right? Thank you very much. Thanks, Richard.
Thank you so much, Kitt-Wai, for your wonderful sharing. So next up, the panelists, right, are going to pick up questions from the audience, including Tyler and myself. So I'll highly encourage the audience, right, to really take these wonderful opportunities to have the presence of our panelists, right, to pose your questions. Considering posing at least one question per person would be nice. We'll do our best, right, to answer all the questions beautifully. So Tyler, would you want to shoot your questions first?
Well, no, sure. I mean, look, I definitely, as I've seen this, I'll start with Lei Yu, and I actually do have a question for Sivi as well. And actually, the experience for Kitt-Wai in helping in working with IPOS in working with some of the first clients to do a disclosure statement around intangibles for listing purposes. So, yeah, I mean, I've been pleased to, or had the pleasure of working with all of them in a business context. So I'll start with Lei Yu first, because I mean the SGX is probably key focus and center of this research. And so my question is like, you've said it's is the report the report shows that the SGX volume is dominated heavily by real estate and banking, right? And is this a concern for you, for the SGX, I mean, my first take when I read through it, I thought, you know, Singapore as an economy is actually kind of always looked at as a safe haven, is a very, very safe investment. And so it almost is a characteristic that there is very safe and stable companies, the banking and the real estate take up a big chunk of that. And that's not a negative if they don't have, it's not a negative to say that they don't have a lot of intangibles, because it's a different sort of flavor of investors that look for these types of investment, and it probably fits Singapore investment psyche a little bit stronger than the US, which, you know, might be a little bit too risky, or there might be too much volatility and things like that. That was my impression, but I'd love to hear your impression if you think that it's too heavily weighted in, you know, banking and real estate, and is the SGX looking to change that, or what would you say?
Okay, that's a great question. Actually, sometimes I think we're a little bit a victim of our own success. So, you know, the REITs product was introduced about 20 years ago, and it has really taken off. And as a result, we have become kind of one of the world's leading exchanges in REITs, and, you know, this great ecosystem here of specialists that understand real estate. At the same time, our 3 local banks have, you know, also punched above their weight. You know, I was just reading an analyst report that said that there are only 2 banks worth buying today, and one of them is DBS. So I was like, wow, that's, you know, that's kind of a great recognition of a local bank, you know, that is viewed globally as a, you know, such a fast-growing and innovative financial institution. But yes, to some extent, I do agree with you. I think because of the success of these 2 sectors, they have become a very dominant part of the Straits Times Index, which is, of course, you know, the kind of the benchmark that everyone looks at. But at the same time, I think it's also worth considering that it's because of them that has also made the index very successful. It is a very liquid index. It's actually more liquid if you compare it to the housing index, for instance. And that is what has managed to attract a lot of both passive and active investors here. So the question is, how do we then diversify this mix? Because first of all, from the exchange, I think we always want diversity. But also, I think what's really you know, more important for us from a national perspective is to make sure that the exchange continues to be a very open and accessible platform for companies from all sectors, whether from Singapore, from the region, should they wish to go public. And there are lots of reasons to want to go public besides raising funds. And we want to make sure that we can provide them the optionality when we do so. So some of the ways that we think about it is, first of all, whether we can introduce different pathways. So I kind of briefly mentioned stacks just now, and not to make this a stacks webinar, but I'm happy to always share further if anyone has questions outside of this. But this was a product that we saw as especially attractive to new economy companies. They are able to show forward projections. There is a ready pot of money available, which provides a lot of certainty to these technology companies, because as you rightly pointed out, they already undergo so much volatility in their everyday business. They want a bit more certainty in the process when they want to go public. So this was a product that we saw, despite some of the challenges in the US market for now, we saw it as something that is not going to go away, and therefore it was worth you know, bringing this product, albeit with a bit of a tweak, to make it more, I guess, in a way to correct some of the what we saw excesses of the US product framework. So that's one way. The other way is, of course, the fact that from a time zone perspective, the exchange is always the one that is the most real time. We work with a lot of partners, including IPOS, including EverEdge. What we want to do is to make sure that there's more education, because if I look at your report, what I think comes across very clearly is that more education and more understanding is required of IA. And I think that is something that is lacking in the ecosystem. I think that is something that we do need to work on. If we say that IA is a function of enterprise value, then the question is the enterprise value today an accurate reflection of what the company truly has? Because when we talk to our companies, they are so convinced, right? They've got great product, they've got great solutions, but they might be struggling a little to articulate that to their investors and to the wider audience. And from our side, we have to try to identify how we can work with our partners, to make sure that this is better understood and better pushed out.
All right.
Go ahead, Richard.
Thank you, Leyu, for your kind sharing. Tyler, you want to say something?
Oh, I was just going to respond and say, look, you're very, very right in your comment, and you'll be happy to know that I'm working with one of our clients who's going to be listing, Catalyst, and they are a robotics and AI company. So we're going to hopefully expand the IP, balance a little bit. They're planning a Catalyst listing, Q1, Q2 2022, and we're working with them on that. So. Keep an eye out for that.
I look forward to welcoming you, although you be virtual, but we look forward to welcoming you at the IPOS.
All right, thank you, Tyler. Okay, there is a question coming up from the audience from Mr. Tan Hong Jun. So we'll always give priority to the questions from the audience first. His question is education needed across all stakeholders in Southeast Asia to better appreciate IA, which means intangible assets, and for management to articulate also? I would like to pose this question to the floor.
Richard, maybe I'll take this question.
Okay.
And also in line with you just now mentioned about education, so I thought we can just take it, at least share a bit of a perspective, because we have an IP academy that conducts IP or IA trainings for the wider audience. So the answer must be yes, right? The education is a continuous journey process, right? So, I mean, even though we set the academy up 17 years ago, today we feel that we are still continuously required to build required capabilities, skills, or knowledge. So every year we train more than 7,000 learners, and more than half came from the enterprises. So to the question, actually all stakeholders are required to be trained up, not just management, not just enterprises. The supply side or the demand side, we call it, needs to be in sync. So the service providers, including the investors, and we also train our public officers, right? Because they formulate policies. So I think just to be a bit more surgical, for enterprises, from our experience, we see that the best route is always through the management route or the CEO's route, right? Because once they appreciate and understand how IA forms the bulk of enterprise value, they naturally will want to find out more, right? And the process of finding out more or strategizing always be tied in with learning about, right, for example. So it's always an education. So I'll just give one or two examples. We work with various universities, NUS, SMU, to run quite a few courses for enterprises on IP strategy, IP commercialization. And recently, one of the most popular things that we did, I think that includes ASEAN, I think, which is what the question alludes to. So lastly, we also run a couple of seminars for ASEAN stakeholders. So ASEAN is our backyard, we always say, right? So officials from all the ASEAN countries, most of the ASEAN countries actually, also attended our courses. So hopefully through all this outreach and skills trainings, we're able to progressively lift the skills and awareness up. And then together as an ecosystem, we continue to build this vibrant activities on IA and IP.
All right, thank you.
Point though, I mean, so I completely agree with you. Obviously, your education is very important. I do think that by nature of it being intangible, it is difficult for people to understand and even maybe I would say see it as credible sometimes. Exactly what is IA and does it make sense? I mean, I feel that mentality would still persist, especially in Asia. So what IPOS is doing is very important because it's not just about educating, but I think creating something that is simplified or more streamlined so that people can kind of get a general understanding and holistic understanding of it is really important.
Yeah, I fully agree with you. I mean, we all know that IP or IA is a multidisciplinary discipline. It comprises legal rights, IP legal rights. Then there's the business application. Then a lot of time there's content, whether it's technology or others. So you really need to synthesize all this information, and it's not easy. It takes time to attain all this. Perhaps we also find that one of the best way to do this is to do it through partnership, right? So IPOS alone has our own community, but we are talking about enterprises in all the various innovative sectors. So for example, I'll be more than happy to work with SGX and together through you for your clients, right? Just like how we work with the various business associations or the schools, together in partnership, we can reach out to their stakeholders. So that's one way of applying IP into the context rather than getting them to see IP as a leader, right? So I think that's a progressive thing that we hope to do more.
Okay, thank you, Kitt-Wai and Leyu for your sharing. Okay, next up we have not questions but two comments from the floor from this gentleman by the name of Eng. Okay, maybe I can read out the comments and you see if there's some opinions that the floor can that the panelists can contribute. Okay, the comment is, I think SGX can play a really catalyst role by allowing local SME who individually cannot get listed to group together under one umbrella based on certain verticals, say cybersecurity, stronger together. Comment number 2 is form initial group for say 1 year, and number 2, formal listing. So players like EverEdge can supply IP expertise and advice. Any opinions, any feedback on these two comments?
Okay, first of all, actually that's allowed. That's not an issue. But I suspect what this question is asking is a bit more technical, which is I think they're asking about the possibility of taking minority stakes. So that can be an issue for any kind of a disco. You know, if the companies come together under one umbrella, HoldCo, for instance, and under a certain sector, and and the HoldCo has majority ownership or can demonstrate control, basically, of all these investee companies. Actually, that's not a problem in general. I mean, there are companies that are listed, like they're like investment HoldCos, where they are basically holding subsidiaries in a certain sector. So that is not an issue. But if it's a minority stake and they're unable to demonstrate control, then of course it becomes a problem, because the listco is supposed to be accountable to shareholders, right? And if you don't have control over the operating business, then that's an issue. I don't want to get too technical, but I suspect that's the question. But actually, to be very simple, it's actually allowed. And if to this Mr. Eng, if you are able to do that, I think we'll definitely welcome you as well. I think that's something that we're happy to bring to SGX.
Richard, if I can just add, it's a good idea, but I think asking the SGX to take the lead in that is not going to happen. It's the private companies have to come together, form that holding company, make sure they're all aligned, same business objective, because they are accountable for the fund. But it's a good idea, and it has happened. You just need to come together, make sure that you're in the same space, you have the growth potential, you have the figures as well, then you're stronger together. Thank you.
So the people you should be going to are the lawyers, for instance. They are the ones who will advise you on how to structure it.
All right, thank you, Leyu. Thank you, Sivi, for your opinions on Mr. Ng's comment. Okay, next up, I have another question from Mr. Dixon So. Okay, do you think more can be done to manage IA vested in a company that is in distress? For example, can a company use its IA portfolio to resist and insolvency application. Anyone want to pick this question?
Maybe I'll just start quickly and then I'll pass to the others. If you are in a distressed situation, obviously it means you've got creditors, you haven't paid your bills. So how do you pay those bills to satisfy the creditors? Right now, if you have a strong IP, of course, what you can try and get is a white knight who might come in and who's interested in that IP asset or IA asset. Then the white knight comes in, takes over and settles most of the thing because it is getting something of benefit to itself. If you don't have a white knight, if there's nobody who's interested in your IA, you may think you have a very good IA, but at the end of the day, if you cannot pay your bills, that's the main problem. A receiver or liquidator who's appointed might appreciate the IA and might try to make steps to approach investors who might then come in and say, okay, we will come in, invest in the company, and that can hold off the potential liquidation. But if you cannot find that, then it's going to be a bit hard. And yes, I agree. The IA, if the company goes into a liquidation and is wound up, the real value of the IA is actually lost. Right. So it's a very strategic kind of approach how you do this. And you need to have either a white knight or a strategic party that's prepared to come in and look at that.
Just to add on to that, I think when we've seen, insolvency situations and a company who has really strong intangibles, a lot of times the intangible assets are only good in the hands of the current people who know how to use them. So if it's a technology, if it's a patent, right, how it is applied or how it is used is important as the patent itself. And sometimes the know-how and confidential information needs to go with it. And so in those situations, there could be some value for the actual inventors or the creators of it. And so to them, it's most likely worth the most. Now, the second piece is somebody who is a competitor to them who wants access to that. So, I've worked on both sides of that where we've helped the founder then buy back the IP out of insolvency because it's valuable to them. But they either sold it off or weren't a part of the company at the time and they didn't have control of it. So yeah, there's definitely pieces of that if you have a strong IA position and you can articulate that value, you'll have more capital thrown at you. You have more options to, that company will be saved. So.
Well, thank you, Tyler. Thank you, Sivi, for your opinions. Any more opinions from the panelists before I shoot my own burning question? Oh, all right. Okay. My burning question is: we all know that Grab is going to get listed today, US time, via a SPAC. We all know that, and the next question would be revolve around SPAC. So how does the SPAC regime help attract more fast growth and intangible asset rich companies and influence capital flow and transactions to SGX, for example? I would like to especially pose this question to both Lei-Yu and Sivi.
Sure, I can go first. I think I touched on it briefly just now. I think the SPAC product is attractive to new economy companies because the structure is simply, it does allow companies to forward projections, and for technology companies, that's very important. If you look at traditional IPOs, it tends to be more of a historical look back structure because they are very focused on 3-year financials, etc. So that's one thing, because for technology companies, their projections are always exponential, right? They're talking about J-curve growth. Another thing is, of course, the process. There is a set valuation that is agreed on before they actually list. This is very similar to what we call a reverse takeover here, with the added advantage of there being ready money. Even a reverse takeover here, you still have to raise funds in the market. So these are just some of the reasons why companies would like SPACs. And of course, being able to ride on the reputation of a well-known sponsor who is standing by you to bring you in. I think all these, especially for companies that may be in subsectors that are less well known to the public, maybe more deep tech or less well understood sectors. These are all reasons for them to do so. Now, Grab is a household name, so why would they need it? I think there are a few reasons, and you probably have to look at the Altimeter's spec structure to understand that. But I think one key reason is, first of all, the Altimeter name. That is a very well-known name, and that definitely in itself already ensured ready investors. The US market is the deepest market, again, in globally. And I think for Grab, at the amount of money that they were looking to raise, I think the US market was really the right market for them. Now, the question is, could they have come here? Definitely, they could have, of course, and it would have been very welcome here because of, again, how well known they are in every household here. And especially the ability to attract retail investors, I think is something that would have been attractive. But I think for them, the ability to go into an established vehicle in the US and the ability to raise, again, that money at that kind of valuation was something that was attractive.
All right, thank you. Let you. Next up, I would like to call upon Sivi, okay, to perhaps comment on to share your thoughts on Lei Yu's comment from a legal point of view.
Sure, thanks, Richard. I've actually acted for one of my clients on a SPAC transaction, so it was listed on the NASDAQ for SPAC. I can tell you that a SPAC transaction from a legal commercial process is not easier than a normal SGX listing. It's different, but there's a lot of work that still goes into, there's a lot of accountability, a lot of planning, and also due diligence that's involved, because you're looking at a promoter, a sponsor that's got to be good and trustworthy and able to attract its shareholders to keep the money in the SPAC. You're then looking at the target, which also has to have a good, solid, exponentially growing business. You put the two together and that's your successful formula. But to get to that point, parties must be prepared to share a lot of information, due diligence, because when you list the SPAC then and you put the business in, all your shareholders are going to ask you, is this really what it is? And you know, in most of these cases, if you track the SPAC history in the US, yes, very active, all that, but when they start trading on the first day, the price tends to drop. Right? And that's a historical fact. It always happens. Then the shareholders get a little shaken and say, well, what's happening now? And will it come up again and all that? But that's just the nature of the SPAC. So I'm glad that we have the SPAC here. I'm looking forward to the first few that are going to be launched here. It will attract funds. I think the money that's going to be coming here from the sponsors would probably be Asian money. And that's probably what we're trying to attract. And find some good companies, good high value companies that will then SPAC and be listed here. But I just want to be clear with all our listeners, because I get calls. We've probably got like 10, 15 people who've called us over this year, you know, saying, oh, SPAC and all that. I said, listen, guys, be very clear. There's a lot of work to be done. It's not a shortcut method. And if we are going to act for you, we're going to go through that process with you as well. And it'll be painful, but it'll be worthwhile at the end of the day. Thank you, Richard.
All right, thank you, CV. Okay, now that we've come towards the end of this webinar already, okay, on behalf of EverEdge, right, I would like to thank, you know, Mr. CV, Mr. Kitt-Wai, and Ms. Lei Yu for your wonderful discussion, wonderful contribution today, and of course, you know, not forgetting Tyler as well. And to the audience, right? Okay, I'm sure, you know, many of you would have many burning questions like me, but perhaps wouldn't have a chance, right, to pose a question today. So fret not. Okay, you can always go to our EverEdge website, right? Okay, go under the Get in Touch tab, so that you can register your company's name, right? And I can personally get in touch with you to answer your further question. How does that sound? Thank you so much, everyone. And I hope you have.
Thank you, Richard. Thanks, Tyler. Thanks, everyone.
Thank you, everybody. Appreciate you attending. Thank you, everyone who participated. And we'll talk to you when we release the next version of the research report, probably 12 months from now. So thanks, everybody. Take care.
Thank you.
Thank you, everyone.